Welcome to the debate. So, our focus today is on something that's, it's really seizing the attention of, I think, every major investor and central bank globally, the recent, and I mean sharp, decline of the US dollar. It's reportedly fallen by over 10% in just the last 6 months, which is the fastest rate we've seen since, 1973.
And that weakening is deeply significant. It's not just, market volatility. It's forcing a very serious reconsideration of the dollar's role and its long-term viability as the global reserve currency.
Right. So the essential question for us today is whether this decline is merely a temporary recalibration, a painful but cyclical event driven by specific policy adjustments, or if it's pointing to something deeper, a systemic, quiet erosion that looks a lot like the collapse cycle of previous global currencies.
My position is that we are absolutely witnessing a structural failure. I'm going to present evidence that suggests the U.S. is, pretty far along an unavoidable historical path toward losing its dominance. We're at a critical inflection point.
And I'll be arguing for the dollar's inherent stability and its structural resilience. While I agree the short-term data is troubling, I maintain that the dollar's entrenched status in global finance provides a buffer that's powerful enough to prevent a true systemic collapse. So let's start by just defining the immediate pain point. And I'll be the first to acknowledge the factors that traditionally support a currency's stability. They're looking pretty weak right now. And that's the direct cause of this 10% depreciation. Investors are highly concerned about fiscal stability, which is really pillar 3 of what supports the dollar.
And that concern is completely justified by the numbers. The instability is, frankly, breathtaking. The U.S. federal deficit and debt pile have ballooned to nearly $37 trillion. And what's even more alarming is that the annual interest costs on that debt now exceed $1 trillion a year.
The rating agencies certainly noticed.
Exactly. That trajectory is what led directly to the downgrades from Fitch and Moody's in 2023 and 2025. They explicitly cited a deterioration in governance and increased fiscal vulnerability. These aren't just political statements. They're institutional warnings about solvency being sent to the entire global market.
I understand the gravity of that fiscal position. I do. But I think the talk of an immediate terminal collapse is, it's more drama than reality. The dollar still has this kind of structural superpower that acts as a fundamental safeguard against a total crumbling. Its status as the world's dominant reserve currency. That role creates constant non-negotiable demand.
But for how long can a superpower that's derived from the past counteract the present reality of decay, a decay that's driven by unchecked debt and, money creation?
For as long as the infrastructure of global commerce dictates its use, which could easily be another few decades. Look at the data that reflects actual use. The U.S. dollar was on one side of roughly 88% of all global foreign exchange trades as of April 2022. That share has been remarkably stable for decades. And on top of that, it's deeply embedded in commodities, the whole petrodollar system, and global finance, which creates structural demand you just can't reroute quickly.
That transactional argument makes sense in the short term, but I think we have to pull the lens back and look at the historical timeline. When you contextualize this decline within that larger historical framework, you start to see a haunting and, I would argue, an unavoidable pattern.
You're talking about the historical collapse cycle?
Precisely. Every single global reserve currency before the U.S., from Portugal to the Dutch Republic to Great Britain, they've all marched through the same 7-stage collapse cycle. And by all indications, the U.S. is well into stage 6, the loss of confidence that comes right before the end.
History offers crucial lessons, sure. But I'd maintain it doesn't offer an exact predictive map for the 21st century.
I believe the pattern is consistent because the economic incentives are just fatally flawed. The U.S. has enjoyed this exorbitant privilege, which essentially lets it run perpetual deficits, importing more than it exports, and just rely on printing money, because the world needs the dollar to function. This privilege guarantees a slow, comfortable slide into living beyond your means, which always manifests as structural debasement.
We both agree that excessive money printing is reckless, but let's just make sure the audience grasps the sheer scale of what you're referencing here.
The scale is unprecedented. Consider the debasement events just since 2008. The U.S. is printing more fiat dollars since the financial crisis than in its entire history before that point. After the 2020 pandemic alone, the Federal Reserve printed an estimated $5 trillion to stimulate the economy. To put that figure in context,
The entire U.S. economy in 2019 was about $21 trillion. We essentially printed a quarter of the prior year's economic output with a few clicks. This unchecked creation of currency, untethered from gold since 1971, is the fundamental undermining factor.
Yet, as I said, transactional usage remains high. That 88% figure still holds.
Usage is inertial, trust is not. And the erosion of trust is real, it's quiet, and you can see it in what central banks are doing. The dollar's share of global reserves, the money central banks choose to hold for safety, has dropped from 72% in 2000 to about 58% today. That represents a multi-trillion-dollar diversification away from the dollar by the world's most informed financial institutions. That shift is the truest measure of waning trust.
Okay, let's pivot now to the immediate pressures, specifically current monetary policy, as we look at our first core point of debate. While the long-term money supply issue is a real structural problem, the immediate downward pressure on the dollar is, I believe, fundamentally cyclical. It's driven by expectations and the reality of interest rate shifts.
Explain the mechanism you're seeing.
It was late last year with more expected. The returns on U.S. government bonds and U.S. savings accounts just drop. And this makes dollar-denominated assets much less attractive to foreign investors who are looking for yield. So when net foreign capital looks elsewhere, demand for the dollar falls and the currency weakens. This is a policy-induced issue, not terminal decay. It can reverse when rates rise again.
I just don't accept that this is the core issue. Interest rate adjustments they're simply the Fed frantically trying to manage the symptoms of structural insolvency. The core issue is that underlying supply. If the U.S. government continues to run these large budget deficits, and we see the federal deficit rising since 2023, the Fed has to print money to fund it or else risk an interest rate spiral.
That's a false dichotomy. The Fed doesn't have to print money, it chooses to.
But the political pressure to monetize that debt and avoid any kind of austerity all but guarantees that the money supply will continue to inflate, and that guarantees a steady reduction in the dollar's purchasing power, regardless of short-term rate games. You're focusing on the water level when the drain is clogged and the faucet is running wide open.
But if rate cuts were the sole cause, why isn't the currency strengthening now?
That is exactly my point. We are seeing something historically abnormal right now. Dollar weakness despite U.S. inflation rising recently to 2.9%, up from 2.3% earlier this year. Normally, higher inflation would force the Fed to raise rates, which would strengthen the currency. This divergence, the dollar falling even as costs rise, is a severe indicator of deeper economic instability. It's fueling legitimate fears of stagflation, stagnant growth with unchecked inflation, which just utterly destroys currency confidence.
I think stagflation fears are premature, but I agree that divergence is certainly concerning. So let's connect that concern to the second point, de-dollarization efforts and the reserve currency status. You cited the drop from 72% to 58% of global reserves.
Right, and that allocation shift is not academic. It is trillions of dollars physically moving. This is central banks diversifying away from exposure to U.S. fiscal risk. Beyond that, we see active, high-level efforts to build alternatives. I mean, look at the BRICS nations, Brazil, Russia, India, China, and South Africa. They now represent 35% of global trade. That's up substantially from 20% in 2015.
And what specifically are they doing?
They are actively moving away from dollar settlements. They're settling trade in local currencies, mostly the Chinese yuan, and they are buying massive quantities of physical gold instead of U.S. Treasury debt. This movement is specifically targeting that crucial global need for the dollar, especially in commodity markets.
That's a compelling point about fragmentation, though. I'd frame it a bit differently. I'm not convinced that fragmentation, even widespread fragmentation, actually equals replacement. The central defense of the dollar is this. Unlike in previous historical transitions, there is currently no single viable replacement anchor ready to take its place.
So the world is just forced to stick with a demonstrably failing anchor?
Effectively, yes, because the global system requires stability, open capital flows, and international trust that's backed by the rule of law. The Chinese yuan, it lacks open capital flows, and it's controlled by an opaque state. The euro is still structurally fragmented, dealing with its own debt loads. The dollar remains the global operating system.
But the system doesn't have to be replaced by a single new thing. The threat is decentralization and, massive inefficiency.
But that inefficiency comes at a huge cost to global trade, and economies hate cost and uncertainty. The dollar is the unit of account for oil, for copper. It manages over $70 trillion in international debt. The world requires a reliable medium of exchange. The dollar still performs that function far better than the chaotic non-system you're describing. Its collapse is unlikely. We're seeing controlled chaos at worst, not a terminal failure of the infrastructure itself.
If the infrastructure is so strong, then why are the most sophisticated risk-aware investors behaving as if a terminal diagnosis has already been delivered? And this moves us to our third point, investor psychology and the flight to hard assets.
I view the moves by wealthy investors into gold, real estate, Bitcoin as tactical, risk-off behavior. It's driven by immediate fears, not a certainty of collapse. These are hedges, and hedges are not inherently superior long-term investments. I mean, gold fell for 8 straight years after 2012 when confidence in the dollar stabilized. Prudent diversification is not the same as predicting global financial doom.
But you're missing the crucial distinction here between typical retail fear and institutional positioning. The consensus among major global financial institutions signals a fundamental loss of institutional trust. JP Morgan has publicly warned clients of de-dollarization risk. BlackRock, which manages more assets than most countries, is actively discussing the strategic need for massive international exposure and suggesting that Bitcoin or other assets could ultimately replace the dollar because of the unsustainable national debt.
Those are often statements designed to cater to the highest level of investor anxiety and to sell products that address that fear. They are not confirmed global transitions.
I think that's too dismissive. When asset managers of that scale advise clients to strategically restructure their portfolios, shifting out of traditional US dollar assets into hard, income-producing assets like real estate, or targeting economies outside the US, it signals they see the dollar's structural risks as greater than its traditional safety. They're positioning capital for a new financial regime.
But why hard assets specifically? Why not just shift into the euro or the yen?
Because the failure of the dollar is really a failure of the entire fiat debt-based system, a problem that many developed economies share. Investors are trying to escape the national debt crisis entirely. They are moving into assets that cannot be printed by a central bank. This is a fundamental move away from holding what they see as toxic government debt.
I'm just not convinced by the scope of that restructuring, because the core utility of the dollar remains unchallenged in the day-to-day global marketplace. The infrastructure is just too vast to unwind quickly, even if the intentions of BRICS or institutional investors suggest otherwise.
But the quiet unwinding is already happening. It's quantified in that 15-point drop in central bank reserves since 2000. It's a slow leak, not a sudden blowout, but the outcome is the same.
As we conclude, I want to reiterate that while the U.S. faces, yes, genuine and severe self-inflicted wounds, the debt, the political gridlock, the dollar's structural position remains highly resilient.
A resilience born of inertia, not strength.
Its embeddedness in 88% of FX transactions and its indispensable role as the global pricing mechanism provides a vast buffer that delays and I think perhaps even prevents a total collapse. The question isn't if the dollar will fall, but whether it can survive until a truly trustworthy alternative emerges. That gap buys the U.S. crucial time. The current weakness is a painful, but ultimately manageable, recalibration.
And I would argue, conversely, that the data shows the system is following a predictable, historical blueprint. The dollar has hit the 81-year mark, which is, historically, the average lifespan for reserve currency dominance. The incentives of the exorbitant privilege virtually guarantee decline through deficits and money printing. The quiet moves by central banks and the focus on hard assets by investors just confirm that this cycle is nearing its end, promising an unpredictable and messy global transition.
Whether one sees this as a deep crisis of confidence or a terminal diagnosis, it is clear that forming an educated assessment requires us to fully examine both the dollar's structural advantages and its historical vulnerabilities.
Exactly. Understanding that duality is really the only way to navigate the challenging financial path forward.